Welcome to the deep dive. Today, we are strapping in, really getting into one of the key documents, I think, in value investing history, the 2002 Shareholders Letter from Fairfax Financial Holdings.
Yeah, and you really have to remember the context for 2002. I mean, the dot-com bubble had burst.
Right.
9/11 had just hammered the insurance world, and markets, well, equity markets everywhere were just plummeting. It was not a pretty picture.
A financial hellscape is putting it mildly.
Exactly.
Yep.
And that's our mission here. We're looking at Fairfax, a company that wasn't just, trying to tread water in that downturn. They were actively cleaning up some pretty big internal messes while making these incredibly contrarian bets at the same time. So we wouldn't pull out those strategic lessons, self-correction, the timing.
And the results, well, they speak for themselves. A huge swing. They went from losing, $346 million in 2001?
Devastating loss, yeah.
To making a record profit of over $415 million in 2002. That's nearly $29 per share profit.
It's more than just a good year. It's like a case study in navigating market chaos.
Okay, so let's unpack that chaos. Or maybe that dissonance is a better word. Because internally, the company seemed solid, right?
Absolutely. They hit a 12.8% return on average shareholders' equity, which, crushed the S&P TSX index at the time.
And the book value per share, the sort of underlying worth that jumped 11.2%, up to about $237.
Yeah, but here's the paradox, the really fascinating bit. The market just ignored it completely.
Yeah.
Intrinsic value goes up double digits, but the share price, it tanks, down 26% that year.
Wow. From $164 down to around $121.
Exactly. The market was basically penalizing them, even though they were doing incredibly well internally.
That must create some serious pressure. I mean, if you're a deep value investor, seeing your stock price hammered like that while your internal numbers look great, how do you keep the faith? How do you justify that to shareholders?
Well, the only way is pure conviction.
Right.
Believing in your own numbers. They knew the book value was climbing. They knew the market was caught up in, fear and short-term noise. And their investment results backed them up. That's the key.
Right, because while other markets were bleeding.
Hemorrhaging, North American, European markets down 15%, 20%, even 35% in some cases.
Fairfax's total return on their investments was 11%, positive 11%.
Positive 11%. They just defied gravity that year.
Equity portfolio was the real star there, wasn't it?
Oh, yeah. Equities alone, they returned 25% in 2002.
25%.
And here's the kicker. If you look at the 3 years ending December 31st, 2002,
Okay.
their total return on equities was 101%.
They doubled their money on stocks during that crash.
Doubled their money while everyone else was losing their shirts. That is what sets a great investor apart in tough times.
Okay, but brilliant investing needs a solid base. Let's shift to the core business insurance. How did they get that consolidated combined ratio down to 100.1%?
See, combined ratio, that's the crucial number for insurers, isn't it?
It really is. Tells you if you're making money just from writing policies.
Exactly. Expenses plus claims divided by the premiums you earned. Under 100% means profit from underwriting itself. And getting to 100.1%, well, that meant they basically stopped the bleeding.
Stop the bleeding is an understatement. Underwriting losses went from nearly $1 billion
$972 million in 2001. Just atrocious.
down to less than $6 million in 2002.
Yeah, $5.7 million. It's not just fixing things. It's like performing major surgery and having the patient walk out healthy.
So what was the strategy there? Just pure discipline.
Pretty much.
Yeah.
A renewed focus, almost militant, you could say, on underwriting discipline. Profitable growth, holding on to more of the risk themselves, but only if it was good business.
And the Canadian operations were the poster children for this.
Oh, absolutely. They were the stars.
Yeah.
Just look at the numbers. Overall, Canada ran at about 96% combined.
So profitable across the board there.
Yeah. Commonwealth was incredible, 84.1% combined ratio, while almost doubling premiums written, up 95%.
84%.
Then you had Federated at 94%, Lombard at 98.6%, Markel at 96.3%. All growing, all profitable. That's how you do it.
Even the reinsurance side, Odyssey, did well.
Strong year for Odyssey, too. 99.1% combined ratio, and they grew premiums by 68%. So, yeah, the core was solidifying.
What about the U.S. side? It lagged a bit overall.
Overall, U.S. insurance was still slightly unprofitable at 103.6%. But the key story there was Crum & Forster.
Okay.
Their ratio was closer, 103.3%. But look at what they did strategically. They cut their policy count by 80% between 99 and 02.
80% fewer policies.
Yeah, but the premium they charged per policy went up 5 times.
So getting rid of cheap, risky stuff and focusing on higher value business.
Exactly. A massive, necessary shift in what kind of risk they were willing to take on. intense cleanup.
Okay, which brings us to probably the biggest cleanup operation of 2002, the T-Diogy deal. Management called it solving the TIG problem.
Yeah, this was complex but absolutely crucial. Like financial chemotherapy, as you said,
Yep.
fixing past mistakes, taking their medicine.
What was the core problem with TIG?
It really boiled down to the MGA model, managing general agents. Basically, TIG had outsourced its underwriting authority, its pen, to outside agents.
And that turned out badly.
Very badly. Management later admitted it was a big mistake. You lose control of your risk selection that way.
So step one of the fix.
Step one, stop the bleeding. TIG stopped writing that MGA-controlled business, which was about half its premiums, put it straight into runoff.
Runoff meaning just manage the old claims, no new policies.
Exactly, just wind it down. But doing that meant they had to boost TIG's reserves immediately by US $200 million. Plus, take a $64 million restructuring charge.
Ouch. So admitting the problem costs them upfront.
Yep, face the music, isolate the bad stuff. That was part one.
Okay, part two sounds more opportunistic. The acquisition of TRG.
Ah, yes, TRG. This was strategically brilliant. They already owned part of TRG, which was their runoff management company described as one of the best. So they bought the rest, the other 72.5%.
And the financials on that deal were pretty interesting, right?
Very interesting. They effectively acquired US $397 million in book equity. But the present value of what they paid was only about US $204 million.
Wait, so they paid $204 million for assets worth $397 million on the books?
Essentially, yes, which created $188 million in what's called negative goodwill.
Negative goodwill. Sounds like accounting magic.
Kind of. It means you bought something for much less than its stated value. TRG was a bargain, and a good one, too. It had been paying out $30 million a year in dividends for 5 years straight.
Nice. Okay,
Yeah.
so they isolate the bad TIG business, buy the expert runoff manager on the cheap. What's step three?
Step three was tidying up. They merged TIG with another entity, iBike, and that allowed them to distribute $1.25 billion in assets back up to Fairfax, the parent company.
Assets like?
Like shares in Odyssey or some of those profitable Canadian insurance companies, it strengthened the holding company's balance sheet.
And the big lesson learned from all this TIG pain.
Never give your pen away. Never let outsiders control your core underwriting. That was the billion-dollar lesson learned the hard way, but decisively fixed in 2002.
Okay, so with the house somewhat cleaned up, they could really lean into that investment strategy, which, as we said, was incredibly successful in 2002. $738 million in realized gains. Highest ever for them.
Highest ever. And it came precisely because they were positioned against the market mania. They made money where everyone else was losing it.
How specifically? What were the big wins?
Well, a big chunk, $231 million, came from selling about half of their put bonds.
Remind us what those are.
Bonds where the holder has the put option to sell them back to the issuer at a set price. So great protection if interest rates rise or credit quality falls, exactly what was happening.
Smart. And they were short the market too.
Oh, yeah. Made $108 million from S&P 500 puts, bets that the index would go down, which it did spectacularly, plus another $45 million from other shorts, like on tech stocks that were still way overvalued from the bubble. They literally profited from the crash.
Which just proves their point from 1999, doesn't it, when they said the S&P 500 peak might not be seen again for 10 years.
Absolutely validates it. By the end of 2002, the S&P was down over 40% from that 1999 peak. Patience and sticking to fundamentals paid off.
But the letter wasn't just about celebrating wins. They also sounded some warnings, didn't they?
They did. And this is where it gets really interesting looking back. They flagged the massive risk building up in derivatives.
How big did they say that market was?
Estimated at US $128 trillion, which was like 4 times the entire global economy's underlying assets. They called it another catastrophe waiting to happen.
Wow, $128 trillion in derivatives back in 2002.
And even more specifically, they warned about insurers chasing yield by getting into bonds backed by, wait for it, auto loans, home equity loans, and credit card debt.
No way. Home equity loans in 2002.
Yep. They feared much higher defaults were coming. It's basically a roadmap to the 2008 crisis, written 6 years early.
Incredible foresight, or maybe just incredible skepticism paying off.
A healthy dose of both, I think. And that realism extended to their own goals, too. They actually lowered their long-term target for return on equity that year.
Lowered it. From what to what?
From 20% down to 15%.
Why do that after such a good year?
Well, they argued that the company was just so much bigger now. Equity had grown from $10 million at the start to $3.4 billion. Plus, interest rates were historically low. So 15% was still ambitious, but more realistic, more disciplined for the long haul.
Makes sense. Okay, and one last piece on the operational side. The float, the insurance float money.
Ah, yes, the float. The
Yeah.
premiums they hold before paying claims. It stayed pretty steady at around $6.9 billion.
But the cost of that float, that changed dramatically.
Dramatically. In 2001, because of those underwriting losses, the cost of holding that float was a painful 14.1%.
Right.
In 2002, thanks to getting underwriting almost back to break even, the cost plummeted to 0.1%, essentially zero cost.
So they had nearly $7 billion of other people's money to invest for free.
Basically, yes, that's a massive, massive competitive advantage, turning float from a cost center into free capital. Huge operational win.
Okay, but doing that big TIG-TRG deal, buying TRG, that meant taking on more debt, right? Did that worry people, given their reputation for being financially conservative?
That's a fair question. Their net debt to equity ratio did jump up from 42% in 2001 to 55% in 2002.
That's quite a leap.
It is. But they were quick to point out, look, this is still way below our bank covenant limit, which was 100%. So yes, they use leverage strategically, but the absolute priority remained a rock-solid balance sheet and keeping plenty of cash at the holding company, conservative where it counts.
And they had that metric, the holding company survival ratio. I love that.
It's a great one, isn't it? Basically, they calculate how long the parent company could survive, pay all its bills, interest, preferred dividends, with zero dividends coming up from the operating insurance companies.
And the answer was?
3 to 4 years.
Wow, so even if the subsidiaries stopped paying cash up for years, the holding company itself was safe.
Exactly. That's building in a serious margin of safety at the core level.
No, despite all this internal strength, they still faced skepticism from the market, right? Leading them to do something they didn't really want to do.
Yeah, they decided to start holding quarterly conference calls after earnings.
Which they explicitly said they were very much against.
Right,
Yeah.
because it encourages short-term thinking, which they hated. But they felt they had to do it.
Why?
To directly push back against what they called seriously misleading commentary and negative reports that were going around, especially questioning their reserves and financial strength after the TIG deal.
So even for a long-term focused company, sometimes you have to engage with the noise machine just to set the record straight.
Exactly. Sometimes transparency becomes a necessary tool, even if you dislike the short-term focus it often brings. Hashtag tag outro.
What a year. 2002 for Fairfax seems like this incredible mix of fixing past problems, nailing the underwriting basics, and just making these killer contrarian calls in the investment portfolio.
Absolutely. If you boil it down, it's about 1, ruthless optimization fixing TIG. 2, strategic profitability, getting the underwriting right, especially in Canada. And 3, that radical investment success, profiting when everyone else was panicking.
So for the listener today, what's the big takeaway here?
I think it really hammers home the value of focusing on what a business is truly worth, its intrinsic value, and constantly evaluating risk, almost being cynical about it. I mean, think about it. They made record profits and that 11% investment return precisely by avoiding or betting against the things everyone else loved, frothy stocks, complex derivatives, flawed business models like the MGA one.
Which leads perfectly into our final thought for you to chew on. Fairfax, back in 2002, specifically called out the risks in debt backed by auto loans and, critically, home equity loans. We all know what happened a few years later with the 2008 crisis.
So the question for today is, how might you, as an investor, apply that same Fairfax-style skepticism to some of the new, booming, maybe less regulated areas we see now? Things like, say, complex crypto derivatives or maybe highly leveraged private credit deals that are so popular. Where might the hidden risks be piling up today?
Something to definitely mull over. We'll leave you with that thought until the next deep dive.